As dollar went down to our objective, dollar reversed, which would see what? Euro reversing. It trades lower, this high, low, higher high to a level we were aiming for. Once it breaks below that low right here, that low is broken there. If it would have did this and came off that's still a shift in market structure that's bearish. But because it closed below, now here's where you take notes, folks, okay? If you're just binge watching and Netflix and chill type attitude with ICT, you're not learning. You're wasting your time. If we close below the swing like that, you're going to treat that as a breaker. You won't need to think about coming back up into here in this imbalance. Oh my goodness, did you just hear what he just said? He just dropped a diamond. Yes, I did. Yes, I did. I'm going to be doing it all year long. That breaker gets touched right here. Does it respect it? Yes, it does. And we're what? Bullish on dollar. And it's trading to a bearish breaker. So this candle, when it hits it, is going to act as your resistance idea, that support resistance theory. You can't just look at every swing high and swing low and draw a line on it and think it's going to act as support or resistance, folks. I mean, I'm sorry, but that's not how it works. You have to have a narrative around why that specific high or low should act as resistance. And if you look at every instance where a pool of liquidity was rated and then rejected, in this case, the low before that high was formed, that's a bearish breaker. That's logic. That's real logic. That is not, well, every single swing high and low, let's put a line on it. You're going to be frustrated, just like I was, which is the reason why everybody that uses that garbage loses money and they fail. If you believe the statistics, and I think they're accurate, most new traders in the first 90 days lose their account. But what's on the other side of those losing trades? Someone winning. And they're doing what? The opposite of whatever they were doing. So you just can't simply look at every single high and low, draw lines on it, and think it's going to bring you to riches. It doesn't work that way. You have to have a reason why a level should act as resistance. Why should it behave for support? And it's on the basis of liquidity. Has it done damage to traders that would have existing orders above highs or below old lows? Then, once that occurs, that's why I call it a breaker. I named it a breaker because it broke the backs of everyone that would have already probably tried to sell short here. It started to drop, and then they ram it right through them, breaking their what? Future profitable short. That's why I named it the breaker. It's breaking them. And it also does it. It breaks their will. It breaks their courage. They are not going to go back in it. When it goes down here, they're going to be like a deer in headlights. They're not going to trust anything because now they have been what? Demoralized. And they lost money. And retail traders freeze when they lose money. Which is, again, it breaks their spirit. It breaks their winning position that would have been, if they wouldn't have had to stop right there, they'd be profitable right now. And I'm sure there's a lot of traders that were trying to do that in here because what? They looked at these highs over here, had a line drawn on it like I'm having here, but mine was that I identify the buy side. There's orders above that. I want to see it go above those. I don't want to see it go there and act as resistance, go down. There's a lot of traders that went in there, and as it hit that, let's go short, put their stop loss somewhere up here. And randomly, the market goes right to a level that I gave you and the reason why it should go there. And then it does the dirty work of going lower. So for smart money traders that were not able to get short up here, they get another opportunity. They find another bust stop. Here it is, the breaker. It comes right back up, hits it. Sell short. Now we're moving lower. So now I have this level here. Resting below that would be sell stops or sell side liquidity. From this high to this low, the midpoint is equilibrium right here. So at that level and above, we are in a premium. Next draw on liquidity is this low. Real orders are resting below that low. What kind of orders? Sell stops. Why would that be beneficial for the market to trade to that level there? Because they've already taken buy stops here and over here. And we moved sharply lower. So we have to assume internal dialogue is this. We assume that someone with deep pockets, lots of money in big short positions, are holding to get to a level where there's a lot of willing sellers below market price. Now, I said that correctly. They want to see the market drop from this height here and go down below this low here. Why would they want that? Because once the orders that get tripped below this low, as soon as this candle drops down, or the next candle, or sometime in the future, it may not be this week, I could be wrong, right? Below this low, once it trades below that, every sell stop at that price level becomes a market order to sell at the market. So it's tripping in a rush of liquidity in the form of a great deal of sellers at low prices. So what do you do when you go out to the store and you see something on sale and you get the money for it? You buy it, right? Well, to get out of the short position, smart money is holding from up here. They're going to want to buy it back. They're just going to buy it back because it's made 20 ticks. Are they going to buy it because they made, 500 points, ticks, pips, whatever? No. They're looking for a logic behind where the market's going to go and where does it reside, where it has a large degree of contrarian opinion. Sell stops protecting long positions is what's going to be targeted here. That's what's in sight right now. It's advantageous for us as speculators to believe and trust that it's going to go below that low because there's somebody making money right now. And we don't know who they are. We don't care to know. We don't need to know how much they're making, but they're making money. And this type of move is meaningful because it's dropped a lot. So where's it going? Some random level? No. Where there's an obvious level for sell stops resting below this low here. So they sold short to buy stops. So they sold at high prices. And they're going to buy back at low prices, where existing or engineered liquidity will be resting. This here, where it runs up, drops down, that's engineering liquidity. When does engineered liquidity form? Oh, here's another time for your journal. Between here and all the way back here, that's a lot of time. It's a lot of time. So what happens is it takes up to that level, falls short of it, drops down, and traders do what? They go short, which inspires them to do what? Place buy stops resting above here. So when the price gets delivered up there, that series of orders that would be resting above these highs here, plus large fund orders up here, because they're going to trade longer term, and the inefficiency of this area here that's shaded, that's a fair value gap. All of those boxes get checked. So when that happens, smart money, the way I'm teaching you how to decipher price, to engage price, to see the real market, not patterns, not retail stuff, you're looking at it with a market efficiency paradigm. That perspective is you're looking for the fluctuations and delivery of price to do exactly how I'm teaching you it does. It's not trading because there's patterns, whether they're classic patterns or new wave harmonic animal patterns, which absolutely is ridiculous. The market only operates on time and price, and it's going for where the orders are resting, which is above old highs or below old lows, or it's rebalancing areas of inefficiency and price, which is what I'm shading you in this little box right here.